So, hello and good afternoon. I welcome you to today's special webinar, How to Trade the Market Opening of the US Markets exclusively for JFD Brokers. My name is Jens Klatt, and some of you might have listened to this format already, and it has been very difficult over the last weeks because of the low volatility. But right now, we get to see, or we have already seen bigger moves here overnight in the Asia session. If you've seen what happened to the Nikkei here and the nearly 1,000 points intraday range. And in fact, European markets, first, they didn't present themselves that spectacular, but in fact, that changed here. And probably some of you might have seen what happened here in the DAX. And I can tell you something. So today, we will in fact do we'll see how many of the concepts I presented here over the last weeks and months will work, or how they work in reality. So the thing is, first of all, you might remember that, or probably some of you have seen this here. So one second, by the way, let's do it that way. So that was the setup I presented several times here. So it's a strategy which is easily adaptable to several markets, like, for example, the S&P 500, also the Dow Jones. You can trade the treasury markets with that, T-notes, but also, for example, Bund future. Also the DAX. The only thing you have to do is here, you have to adapt the open range. And this is a clear predefined setup. And you also know that it has a positive expected value for 7 years, over 7. Yeah, it should be 7 years. Yeah. And it has a positive expected value. And several times in the past, I was talking about to optimize the expected value of a strategy. And so in fact, today we're not focusing here on this, but I'd like to show you how optimizing the expected value, positive expected value of a trading strategy. I'm trading in an account for my clients. So I'm managing clients' money. And I trade a predefined strategy with a positive expected value here for my clients there. And I'd like to show you how I optimize the positive expected value today and how this could look like, in fact. And on top of that, I'd like to show you, or I'd like to show you, and therefore, first of all, one second, here is the MetaTrader. And you can see I'm having a trade on here. So this is, by the way, not a 5-minute time frame, but it's a 1-hour chart. So usually you can also go here. Oh, no, that's not so cool. One second, let's do it that way. Yes, but this is not the daily chart. Let's do it that way. Okay, so the thing is, you can see here, obviously, I'm having a position on. You can see it here in the P&L. And so let's do first things first here. So before we start with the optimization of the positive expected value here, I'd like to share some thoughts here why I still hold on this position. And some of you might right now say, well, do we really have such a big chance to get to see bigger moves? I mean, we're talking about a drop in the DAX here. If you look at this candle here, we're seeing right now a drop of more than 1%. We opened around 13,400 points, and right now we are trading 170. Yes, 170 points lower than that. And you might say, hey, you have the daily range indicator here. So don't you think that probably we are right now in a mode where profit taking makes some sense? And I completely agree. From a pure mathematical standpoint, or if you're working with the average daily range indicator here, which shows the previous 1 day, the previous 5 day, the previous 10, and the previous 20-day range, I'd say, yes, you're definitely right. Because I mean, the average trading range of the last 20 days here was 100 points, and then only something around 90. So somewhere between 90 to 100 points was the daily range. So right now we have seen already a drop of 170 points, and you might say, well, this is nearly twice as much, because and now probably it makes sense to take a profit here. And I'd like to disagree. I'd like to, let's call it gamble, even though gambling is something which is not the right word because it has some kind of negativity to it. So we are not gambling here, but I'd like to let's put this in quotation marks, gamble here, because I think we are not yet done, and there is some further potential on the downside with the US equity markets probably to open today and follow here on the downside too, and put some serious pressure also then on the European equity markets, also in the after hours of trading. And why do I say all this? Therefore, let's start with the developments here in the Nikkei overnight and what happened here. So by the way, it's 1 year ago that we've seen a move of this or a trading range of this width here. It's 1 year ago. That was the day when Donald Trump was elected the 45th president of the United States. And so since then, market volatility really calmed down, and there was only one direction, especially in the US equity markets. So here we have a look at the Dow Jones. You can see that was the last day when we really saw some volatility. The Dow Jones, by the way, trading in a range of over 1,000 points there and taking off from there. And we haven't seen a 3% drop here since then and also before, which is which perfectly shows how low the volatility right now is. By the way, selling volatility has been the trade to be over nearly the last months, or in 2017 so far. We know that the volatility at the markets is really low. That's, by the way, something I'm sure to use a little later on. I've prepared this already. It's a Wikipedia article here on normal distributions. But therefore, let's have a look here, first of all, at the VIX. And unfortunately, it takes a little long. So here, there we go. So let's have a look here. So this is the VIX, and the VIX here is showing that right now volatility is picking up, and we are trading back above 10. But nevertheless, this is still not a huge and high and elevated volatility level. And in fact, if you look back 1 year, or let's say 5 years, you can see that there were some small spikes here over the year. But all in all, the volatility in 2017 was really, 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 really low. So in fact, before 2017, there has been only, I think, 9 times when the VIX, the volatility index here on the S&P, closed below 10. That was 9 times since, I think, 1970. I'm not sure, but it's definitely, it hasn't been that often that this happened. So in 2017 alone, we've seen here, I think, over 40 times, 47, 48 times. I have to look this up, but definitely it was incredibly low volatile. And or low volatility we've seen here. And so what market participants started to do was they sold volatility in a very, very aggressive manner. For example, if you look up the commitment of traders report, I haven't prepared this chart here, but you will easily find this if you go via the website from the CFTC, cftc.org, by the way, and there you can find some stats at least. So not charts, but you can find some numbers here. You can see that right now the market is heavily short volatility. So, and now the interesting thing, what happened overnight is that here, and especially if you look at the Dow Jones, but also if you look at the Nikkei, what you can clearly see is that the overall developments here in the market, this market structure in the Nikkei here and here before in the Dow Jones, they look very, very similar. And this run here on the upside, while market participants were heavily shorting volatility, caused the market to really calm down in a manner which is right now coming down to the following. And there now we get a little more mathematically here. So let's have a look at this from a normal distribution perspective. In the morning, I've read a tweet which said, right now, a daily 2% move in the S&P 500 would be a 4 standard deviation move. Okay, so right now, some of you might look at the screen and say, okay, what does this mean? One very important thing right at the beginning, big banks, investment banks, they are they have trading systems which enter positions based on simple mathematical rules, like, or, no, simple mathematical rules is the wrong thing, but they are normally working with so-called normal distributions. Some of you might have seen the film Margin Call here. It was with Kevin Spacey, if I remember right, and it was a great film on the meltdown of Lehman Brothers, even though Lehman Brothers wasn't mentioned here in the film, and they worked already here with those models. And I mean, they changed something here, even though the thing is that all in all, nothing changed that much. And those banks are still working with those normally distributed models here. And now the thing is, what we know, that markets do not behave normally distributed. We won't go into too much details here, but I can tell you the following. Right now, there's one reason why they're selling that aggressively volatility, because from a pure, let's call it, model perspective, they do not expect big moves to come, but they just follow the old saying, the trend is your friend. And that said, it means nothing more than if volatility is low, then they are betting that volatility will stay low. And again, now we come back to this. If we are now going down 2%, that would be a 4 standard deviation move. So, I mean, this is not spectacular for some of you, but please have the following in mind. Now we have a look here at this 68, 95, 90, 99.7 rule. So in statistics here is a shorthand used to remember the percentage of values that lie within a band around the mean in a normal distribution with a width of 2, 4, and 6 standard deviations. Respectively, more accurately, here it's 68.27, 95.45, and 99.73. So meaning nothing more as the following, and that comes in play here, known as the so-called 3 sigma rule of thumb. This is related to a result known as the 3 sigma rule, which states that even for non-normally distributed variables, at least 88.8% of cases should fall within properly calculated 3 sigma intervals. It follows from Chebyshev's inequality, blah, 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 blah. So some of you might now think, okay, what is this guy talking about? First, something I'd like to say to you. So I studied mathematics, and that's why I'm going a little crazy about this. So to me, this is really interesting. But I'd like to make this more. I'd like to give you a better idea of why this is interesting. Just imagine the following. So far, what happened here in the Dow Jones so far, for example. But also, if you go over to the S&P 500, for example, so far nothing happened. So look at this candle right now, and we're seeing a high here at 2,591 and a low at 2,577. This is 14 points. And if you calculate now the current drop we've seen, we're only talking about a 0.5% move. It's nothing. But, and this is the thing, look at what happened here in the Dow Jones. Look at how much pressure and volatility we were already confronted here in the morning. And remember that if the market now starts weaker into the day and we keep on dropping, that there will be a point when those market participants who aggressively sold volatility have to sell or have to buy back the volatility they initially sold. The same thing is true for the huge long position they're currently holding. This is a strategy. Oh gosh, I forgot the name of that. It's not market neutral. It's another strategy. I'm sorry, I forgot this. That was also something which was mentioned by Paul Tudor Jones at the beginning of the year or somewhere in spring at a meeting with Goldman Sachs, but I just don't remember the name of that right now. But the thing is the following, and that's what I want to say. Even though it looks quite heavy, what we've seen so far, also in the European markets, right now I'm betting that today is probably the day on which the Dow Jones will finally come down, and this could then put another heavy weight here on the DAX, causing it to yeah, to tumble further and to probably increase my potential gain I have made here on this trade already. And yeah, with this in mind, I entered the U.S. equity markets today. So with this, you can see that I'm always I mean, it's not just that I'm looking here at pure chart patterns or that stuff, but more like I look at the markets also from a wider perspective and try to calculate the possibility here of how likely it is that such an event occurs today. And again, so far we are far away from seeing a huge meltdown here. But if the market accelerates on the downside, and probably it has done so already. Let's have a look here at the Dow Jones and this potential bearish divergence forming here. You can clearly see that so far nothing happened. This is really small, but I think the moment the market moves below 23,300, and by the way, we're only talking about 150 points, which is nothing if you look at the current index reading. We're trading above 23,000 points, 23,400 points. So this is no real big deal, and it can be easily made. But the thing is that the calmness of the market over the last weeks and months has caused the market to be to build a sentiment extreme and being heavily short volatility while being quite aggressively and leveraged long equities. And if this, let's call it the bubble, if this bubble bursts, you have a tremendous potential on the downside. And that's one of the things I'd like to remember here when entering the trading day today, and why I give the market definitely some room to move here if it moves. So the thing is, we've seen several of these moves already here in the past. Remember that. I mean, that was already a bearish candle, and in fact, it's a huge move because it was the third of this. It was the third 1% move on the downside here in 2017, and it happened in August. Okay, so we've seen this before, and not sure if it will play out today or not. But nevertheless, I'm in a very comfortable situation with the short position here already running, and I have no real reason not to say, well, let's go for this. Let's call it a home run. So we are not talking about a big position here. So far, in fact, the position already shows a profit to me, even if I'm now getting stopped out, break even. And this is something I'd like to show you in a few seconds here. But the thing is that with this in mind of the US equity markets, I still consider chances to be really good, that probably we haven't seen the bottom yet, but there's further room on the downside. Also, very interesting to note here, let's have a look at the DAX. Very interesting to know that, I mean, we've seen plenty of those more aggressive drops here. Remember that one. Okay, you can see it here. That happened already on Tuesday, yes. And we've seen a reaction here. So the market moved aggressively higher here shortly after. Same thing happened, and this is also something here. See this? I mean, the market moved aggressively higher, and you could be really sure that there's no further pressure build and attacking this, significantly attacking the region around 13,400 points. Let's go back a little further here. Let's have a look. When did this here, for example? Also, very after the move here, it was on the 19th of October, very aggressive move on the downside, but the market was aggressively bought back. And now look at what's happening today. So some of you might wonder, hey, where does your feeling come from that the market is probably hasn't seen its bottom? Look at how aggressively we were sold here around 11 a.m. GMT. That was a quite aggressive move on the downside, but instead of aggressively reversing, the market keeps on drifting lower, and every try to push the market back is aggressively sold again, and we're seeing a drift lower, which could easily accelerate on the downside. That's also something to keep in mind here, and why I still feel quite comfortable with this position. And yeah, why I want to hold the position. So you can see that market analysis does not necessarily mean you're drawing some lines in a chart and saying, okay, here I have a wedge, or I have a bearish divergence, bullish divergence, or whatever. But it's more kind of, let's also take the sentiment into account here. Have a look at how the market is positioned right now, how the market behaved in the past, and how this potential sentiment extreme fits in the current market conditions here, not showing the same structure as before when the market was all the times bought back and made new highs, but right now it's performing well on the downside. I'm not, by the way, saying that the market will crash right now, but probably today is one of those days where you should be really, really careful with long engagements and don't expect the bulls to take over easily. So probably they will take over. And right now I'm really excited. And so the thing is that if I'm wrong, well, then it does nothing mean more than that the market will somehow drift higher and does not build the pressure I'd like to see in the US equity markets. But there's still this feeling. And let's just see whether this plays out or not. By the way, what I already told you right now, while we want to have a look especially at the trade and how optimize the expected already positive, but the expected value in general here, you can also draw a conclusion in terms of where do I see the current advantage here, meaning nothing more than that. We don't want to take on any long positions today in the S&P. I mean, we are not getting to see a short position being triggered usually when we're trading above the exponential moving average 10 here on a 50-minute time frame. But the thing is that I don't like to go long if the market pushes back above this level. So I'm not going long then based on the open range. Instead, I only favor short engagements. Probably I get to see a short engagement, a short position here triggered by another setup, not necessarily based on the open range. But you can clearly see that I definitely see the advantage to be today, intraday, on the short side. Okay, so that's it. First of all, here around the markets, let me just have a look here at the questions. Okay, fine. So now let's have a look here at this trade again. And let's work with some numbers. By the way, I had to look up my trading journal right now. So I don't really know where I would have been stopped out yesterday, in fact, or where the position would have been taken out here. So I had a stop, but I don't remember the stop. I have to be honest here. But this doesn't necessarily, that doesn't really matter. What we want to do is the following. So we call this optimization of the expected value of the trading strategy. So what we know is that it's very important not to just have a trading strategy which has a positive expected value, but also to know certain parameters of a trading strategy. Therefore, remember some charts I've shown to you here in the past. 1 second. I'll just here give you such a chart. So the thing is that you can see here that this strategy I've just presented to you in fact, this very simple setup has a positive expected value. We're not working with compound interest or something like that, but all you can see is that if you keep on trading this strategy over and over again and do this for 7 years, you can see that you get a very, very attractive result here, meaning you have a hit rate of 47% and you have a payoff ratio, the ratio of the average profit to the average loss of 1.3 to 1. And if you calculate now the expected value, you can see that you have a positive expected value of this strategy. I did the same for the strategy I'm trading for my clients. And I know what is my expected value here, which is positive. So in fact, I'm making a little more than 8 cents per trade per euro we risk here. But the thing is something completely different. So first of all, let me introduce to you this formula once again, the expected value, which is in fact one of the, if not the most important average winning trade formula. You have to recall night if you were asleep and you woke up and you have to give this formula, you just have to give it right away. So this is really, really a very, very important formula you have to remember. And average losing trade. And with this formula, everything else in trading makes sense. So if you read a trading book and you read something like let winning trades run, cut losing trades short, well, it's not very difficult to understand why this is true. Well, because here, if you let the winning trade run and make the average winning trade that way bigger, and you cut losing trades short, making the average losing trade smaller, well, what does it mean? It means that all in all, this term here will increase while this one will decrease. And if you subtract a smaller number from a big number, well, you get a positive expected value, making money in the trading. It's in fact that simple. And so if you now have this expected value here, which is positive, then the target of a trader is, especially a money manager, for example, it is to make sure that the expected value grows. Meaning nothing more than, let's say you have a positive expected value in trading strategy, meaning you're making with a basic strategy already money. And now imagine, one sec, per euro risk. So that means nothing more than, let's say you're risking 1,000 euros. You multiply 1,000 with 8 cents here. And so what you get out of this is that you're making on average 80 euros per trade. So you might say, well, this is not a huge result, but remember, you're not trading the strategy once, you're trading it over and over again, day in, day out. And if you do this 200 times a year, and you're trading a 100,000 euro account, and you're risking 1%, which means 1,000 euros, you're making 80 euros per trade. It doesn't matter if you're winning or losing, but you know that in the long run, you will be on the right side of the trade. If you do this 200 times, you're making 16 grand, which is 16% on your equity, which is a tremendous great result, especially if you can somehow have a drawdown, which is somewhere around or below 10%. So this is a really good result then. And so now, nevertheless, the thing is, you can easily automate the strategy and then manage your money yourself. So what's the job of a money manager here? It's to make the expected value bigger, and somehow not just make the expected value bigger in terms of overall profitability, but also make sure that, for example, potential drawdowns are limited and are, let's say, they are not as big as, for example, a backtest suggests here when you backtest the strategy. So the target is, in fact, but it's not true. Also, it's not only true for money managers, but also for retail traders. It's target. It's also true for small traders, for retail traders. Increase the expected value. So that's that means nothing more than, let's say you are capable of increasing the overall expected value from 0.08 to 0.1, so making 10 cents per euro. Risk per trade, by the way, per euro risk per trade. Well, that means nothing more than that you just increase the profitability by another 25%. Let's come back to the example with 200 trades. Just imagine now you're making 100 euros per trade, meaning you're risking 1,000 euros, making 10 cents. 1,000 multiplied with 10 cents equals 100 euros, meaning you're making 100 euro per trade. So meaning you are increasing your profitability from, let's say, 16,000 euros. You made 80 euros per trade, multiplied with 200 trades. And now you're making 100 euros per trade, meaning you're making 20,000 a year. This means you increased your profitability by 25% from 16 to 20,000 euros. So this may sound really, really theoretical to you, but the thing is that, in fact, this is what professional trading is about and what you try to achieve in your trading. And so what I usually do is not I look at the trade in terms of a positive result it generates. I mean, it would like awesome. It would look awesome if the market really now moves to my target, which where I placed the take profit here around 13,070 points would be great. But nevertheless, the thing is that my overall target in my trading is to somehow try to increase the positive expected value. In fact, first of all, by reducing the average losing trade. So the winners take care of themselves, in fact. So what did I do now? So yesterday, I put a, let's do it that way. So it's the 8th of November. I had a short trade, okay? And this trade would have been closed into the close of the trading day. So at the end of the trading day. And it, in fact, showed a loss, okay? So if the short trade was stopped out, I would have lost something like 30 points. Short trade would have been stopped out minus 30. Let's do it. Let's say. So it's minus 30 points. So today, in fact, and the strategy, by the way, works with a works with a stop loss. Sure. It's not just that I placed the stop loss here, but the stop loss was initially placed yesterday already for this trade before I entered the trade. So to have a clear predefined risk here. Today, the system would have said, I'll enter a long trade here. And in fact, today, with this sharp drop we've seen so far on the downside, the trade would have been stopped out with a loss of 150 points, something like that in this region. Oh, let us do it that way. Okay, so if you combine this result of the strategy minus 180 points. So now you might say, okay, what a bad strategy, right? It loses money. I mean, we all know that no strategy out there works all the time. Okay, so in fact, it's that there will be days when the strategy works really good, and there will be days when the strategy doesn't work at all. And have a look at this chart once again here. So if you look at this equity curve, you can see there were times when the strategy really crushed everything out there, really going parabolic here. But there was also times when we saw a pullback here and the strategy didn't work out at all. But overall, the strategy made us money. This is the same thing, and it's true here for this strategy too, even though the last 2 trading days would have shown a loss here of minus 180 points. Okay, with an adequate and good risk and money management, you don't care about 180 points. In fact, it sounds a lot, but in fact, it's not. And you can easily make this back in no time is the wrong thing, because it depends on the market conditions and how well the strategy corresponds here with the current market conditions. But overall, you can definitely say you will make it back rather sooner than later, probably somewhere later. It doesn't matter, but you will make it back. You will stay in the game. You will keep on making money in the long run. Nevertheless, the target is for a professional money manager and for a professional trader to avoid those pullbacks in the equity curve, or at least, you can't avoid them, but what you try to achieve then is to say, okay, I try to minimize those potential pullbacks here. And this is also, and especially true for money managers, where you have to manage clients' money, and where clients say, hey, I don't want to see losses. And no one wants to see losses, right? And on top of that, you as a money manager, you get paid based on the performance fee. And on a high watermark level, meaning nothing more than you're getting money the moment you reach new equity highs for the equity of your clients. So what you definitely want to avoid is a too sharp drawdown here, because if the drawdown is small, there is a bigger chance that rather sooner than later, you will overcome the former equity highs and then get money again based on the performance fee you negotiated with the client. So that means nothing more. You definitely want to avoid a drop here in the equity curve of 180 points. So what did I do, in fact, was the following. And now I'd like to show you. So I did the following. short trade was migrated. So I'm not even sure if this word exists here in English. Let me just see whether it really exists. Migrate. Yeah, it does. It's migration. Yes, perfect. Okay, so what I did was I migrated the trade, the short trade from yesterday, and took it over in the next trading day. So in fact, I knew before what I was risking here when I took the trade on yesterday in the morning. So I was willing to lose 0.7% on that trade, as I would have, by the way, lost here on this long trade, which would have been stopped out already today. So 0.7%. And so I had a predefined stop level, which was under no pressure at all here. And there was no real risk overnight, to be honest, to be stopped out here. I was also very, very curious about developments in the Asian markets. You might have listened here to my morning meetings I hold exclusively for JFD brokers, meaning nothing more than I was very skeptical if this parabolic move here is probably not about one second, by the way. So we open with a gap lower here. So far, the S&P is already about to close this gap. But this does not necessarily mean we are not probably triggering short here and going lower from there. But before we enter the US equity markets, let me just look here. Okay, this is the Dow Jones. Let's have a look here at the Nikkei again. So I was somehow skeptical already if there's not a good chance that rather sooner or later there will be some kind, at least a small pullback, that we get to see so much volatility here in the US equity, in the Japanese equity market, surprised me. Nevertheless, I had it on the agenda. That was also one of the reasons why I said, well, probably rather sooner or later there will be such a pullback. And why not taking on this short position over in the next trading day? So why not trying this? I mean, let's call it kind of a gut feeling, but overall, this is the next thing. I call this a gut feeling, or especially people from out there might say, well, shouldn't you avoid this, such gut feeling trades? Yes, I should. Nevertheless, if you have a adequate and detailed trading journal where you write down all your trades, what you will find out is, are these gut feelings, let's call them good feelings. And I am more kind of a guy who really wants to see in detail and with clear, clean numbers whether my gut feelings are generating me a positive result. Overall, it's more like gut feeling is nothing more than intuition, right? So it's more like you say, I've seen so many developments in the markets, and somehow I think that we are probably about to see a bigger drop, but I can't really explain why I think that. Yet you can easily describe this by looking at this chart and saying, well, look at the developments here over the last 2 months, and the risk reward and the upside is getting ridiculous. So it's really unattractive to go long here, and rather sooner or later there will be diminishing demand, and then we'll get to see a bigger drop then. And that's one of the reasons why you could enter such a trade. But I want to be honest here and tell you, okay, there was a gut feeling. And that's why I took the trade over in the next trading day. And so the thing is that, again, I had really no risk which wasn't calculated before. So I knew that my risk is 0.7%. The only problem I would have had today is if the market started out long, because then I'm in a short trade, which would have been stopped out yesterday with minus 30 points. And then you take the long trade here, or you didn't take, I didn't take the long trade, in fact, which means that here, I wouldn't have been positioned then on the long side too, which would have caused a big loss then, in fact. So all in all, even though I probably might only have lost 0.7% here on this short trade if the market moved on to higher highs. But the thing is that I would have made this here with the long trade on the other hand. So that was the risk I was taking here, but I was willing to take this risk. And so I migrated the short trade here and didn't take the loss of minus 30. And so on the other hand, by the way, yes, that's right. So it's the 9th of November today. Long trade wasn't taken. Means I have already a plus 150 points here because what we know right now is that I didn't have to take the loss of 150 points, which means I have it on the I have it still in my account, right? So I haven't lost those 150 points. So I'm already ahead 150 points, and now the great thing is that I was capable, and this is exactly what you can see here. I was so far capable of moving my stop to break even here. So you can see here that was the price I sold to the DAX yesterday. And I was capable of moving here my stop loss here to break even +1, meaning that all in all, I can already say that so far my result, while I still have the position, my result is +31 here, because I have not taken the loss yesterday, -30, and I've already the stop moved to +1 here, meaning that I made so far 31 points on this trade. Meaning that my overall result based on, well, the thing is, I don't like to write it, but let's call it skill. Result based on skill so far 181 points. Obviously, the difference is 361 points. And by the way, we're not yet done. So let's see whether the market keeps on moving lower here. I'm not sure how I will manage this trade. Probably I'll get more aggressive with my stop here. Well, probably it moves to my target, 13,070 points. I don't know. Really, I just don't know. It's 130 points to go. By the way, it's not much if the US equity markets keep on moving lower. And that would then cause an enormous difference here of something like, I don't know, what would it be? If I make the profit on this trade, this is something like 300 points then. Yes, so it's more than 600 points better. I perform 600 and more points better than what I've performed if I just traded the strategy. And this is what I'm talking about when I talk about optimization of the expected value of a trading strategy. And this is what can make the difference, the long term, of a positive performance, or let's call it a super positive performance, or what you're getting paid for when, for example, trading money for your clients. And even though that might purely sound or 100% theoretical, you can easily understand what I'm talking about, because this should be your target. And in fact, if you start to really believe that, and you really believe that this is what professional trading is about, your focus will completely change from trying to catch moves higher or lower towards, I try to increase my already positive expected value, what I know based on the backtest I've run here for several times, several years, and where I know that the strategy works. When you say, okay, and now I try to optimize this strategy with my knowledge about the market, which could, by the way, now some of you might say, okay, but where do you get this knowledge from? I mean, sure, it's about you have to, for example, follow the markets for quite a while. Or, for example, you have to understand certain techniques like market structure. It's that I say, well, let's say you have a structure of higher highs and higher lows. The question you have is, where shall I buy here? Shall I buy right here when the market is about to break to new highs? Or shall I buy once the market here drops to further highs, or to highs from before, and where we then say we try to buy into this regression. In fact, sure, we should buy the regression or the move here, the move lower, because the risk reward is so much more attractive. But on top of that, it's also that you will easily understand that this is usually the area where you start to position yourself with the advantage and with other and bigger market participants who have to find regions where they find enough volume here to build their positions. So the thing is, just imagine you're a big fund manager or a trader for an investment bank, and now you get an order from one of your biggest clients, like let's say it's Allianz or something like that, and they are saying, hey, we have to buy Apple shares worth 10 million for our portfolio. get us those shares as attractive as possible, else you lose us as our client. So the last part, they won't tell you that, but this is exactly how this business works. So your job is to get those 10 million shares as an execution-only trader. So we are not talking about prop trading here, it's pure speculation, but you try to get those shares for your customer because he wants them or he needs it for their portfolio. So, well, what does this mean? It means you have to find a region where you can easily get those shares for or to a good price. And good price does not necessarily mean that they have to show a profit here, but it's more like good price means you will calculate this, for example, based on the volume weighted average price. It's the so-called VWAP here. I'm not introducing this technique right now to you, but based on the VWAP, if you're buying below the VWAP, it means that you're making a profit for the client, and this is, by the way, what your bonus is calculated on when you have to buy those shares. So now the thing is, you have to somehow make sure that that you find enough volume in the market. And where do you find it? Do you really think you find it here at those highs? I don't think so, right? Because everyone is looking at those highs. All those market participants being short here, for example, they will, if they understand market structure, and if they go anti-cyclical short in this structure of higher highs and higher lows, they will say, okay, I'm stopped out here, because then if the market moves to higher highs here, we'll move into a new progression, we call this. And this trending structure is forthwritten here on the upside. And this is definitely a place where you don't want to be short anymore. Or the market participants saying, okay, I have to call to buy the breakout to new highs here. Right now, for example, if you look at the DAX, for example, and you look at this really aggressive move, let's have a look here on the upside. So you're looking at this move here, and some of you might have wondered, why did the market push that aggressively higher? I mean, at the afterwards you can say, okay, that's easy, but all in all, we have to say, hey, this move somehow had to be expected, because into the yearly close, there were several market participants who had to buy the break to new highs here. They had no other chance than doing exactly that. And so this is the place where those market participants will come into the market and buy aggressively then. So it's not just that short trades are getting stopped out, but it's also buyers here who buying the break to new highs then. And now imagine, once again, you're looking here at an order from one of your biggest clients, it's Allianz, and you have to, as an execution-only trader for an investment bank, you have to buy 10 million shares, Apple or something like that. Do you buy here, or do you try to somehow accumulate the position already here? And this is exactly the thing. You try to accumulate here, because here you will get trouble to get those pieces you need to satisfy the needs of your client, or to satisfy the order of your client. And so this is exactly the thing where, let's call it, the skill component comes into play, and how you can build a deep knowledge here, for example, about market structure, and how to use this then in your trading, where you say, okay, now I'm trading a trading strategy, and I use this knowledge to somehow make sure that I can optimize, or let's put it that way, that I can optimize the already positive expected value of my trading strategy and make an even bigger profit here. Yes, so that's it. That's it. 1 second, I just have to see here. Are there any questions so far? Yeah, if you have any questions, please shout them out loud right now, or no, write them in the chat box here of the YouTube chat box. I really like to answer them. So we have 10 minutes left, and so far, let's have a look here. Look at this. This is what I love. I mean, sure, I do, right? So if you look at this strong move no lower, this is exactly what I was talking about. The market didn't show any willingness to reverse here. So I'm not saying it was the only way to go, but I mean, there was still some hope. Nevertheless, I hope that I sounded somehow really convinced that this will happen, and it's exactly what's happening right now. But now the thing already starts to get interesting, because I have to see that I will start to move my stop here, because there's always the chance, and that is something we have seen so many times in the past, that the market will reverse aggressively. probably right before we are entering this, let's call it critical moment when the market is probably about to drop aggressively low. By the way, look at this. The S&P hasn't shown big action on the downside at all. So the high so far is 2,580. And so far the low is, so yes, we definitely get to see a trade, but therefore that's also something I'd like to present to you here. One sec, let's just see. So we can't formulate a trading setup so far because it depends on the open range in the S&P 500, but 580. We have to wait till by the way, open range. I'll put this here till 3:15 p.m. GMT. So these are the numbers you have to look at. Okay, so we are still 25 minutes from a clearly defined open range. So we have to wait for those numbers. I think it will be a 5 here. Let's put a 5 here, but then we have to wait. So far, the open range is 573.8. Okay, because this is the current low. Nevertheless, there's a potential that the market will move lower from here. If you have the open range, then what you will do is, and let's go back here to this one. What you do is you identify the advantage based on Dow theory, respectively on the 50-minute EMA, while I'd suggest going short. Again, well, sure, I suggest going short, well, because I'm short. So no big surprise for you guys that I don't want to make long topics, long engagements here, long setups as a topic. From a pure technical standpoint, I shouldn't be influenced by this, but nevertheless, so far, I'm a strong believer that we are not yet done on the downside, meaning I don't want to be long in such a market environment. So we identify the advantage based, usually we do this, and we look at the 50-minute exponential moving average 10. If we're trading below that, we take the short side. If we're trading above that, usually we take the long side. And then we do the following. We trade the break of the open range in direction of the identified advantage, while we put the stop above, respectively, below the high, respectively, low of the range. Meaning nothing more than, if we take the short side, then we can say the following. So the entry short in this case would be 2. We don't know. The stop, if we don't trade higher than 2,580 right now, we have the risk here. But the stop, this is where the stop will be placed, risk ... I don't know. And then we go for the target, which is today open. So in fact, what this chart here, this equity curve is based on is very simple. I usually enter a trade and I close it automatically at 8:50. Yes, 8:50 p.m. GMT, automatically. So there's no other way than doing that for me. But some people might say, hey, probably it's worth to calculate a predefined target we can go for. If you want to do that, I already checked the market here before we started with this event, and I'd say, well, probably something around 2,562. That would be the first target. If there's really pressure coming up, then it's 2,540. By the way, if we move to 2,540, be aware that with such a move lower from this level here, we would definitely enter a region where the 2% would become a problem. So meaning, if we really drop to these levels, for whatever reason, if the market really starts to take a deep breath, let's say, and pushes that low, and we move to this level, this is the least point I want to go long, because if we drop below this, I think, well, it sounds strange, but I think hell will break loose. I think that this is the point where we can easily drop another 40, 50 points here on the downside and see a deep red day. And that's mainly based on what I described to you at the beginning, because of this 68, 95, 99.7 rule. And the fact that a 2% move right now would be a 4 standard deviation move in the equity markets. So I really wouldn't go long then, but expect the market to really aggressively sell off. Yes. So that's what you probably were wondering. So you can also calculate targets here, even though I make things really easy here because I know about the fact that it's a positive expected value. Also, very interesting strategy question from Kyle. It's is the strategy just applied, or can it only be applied to the index? Where in index markets like S&P or Dow Jones or Nasdaq, or also the DAX, for example, FTSE 100. It can, in fact, can be adapted to all these markets depending on a time frame in which you're looking at those markets. It should be a market opening strategy, but the question is, can it be applied to Forex pairs? Yes, in fact, it can. And so there's a strategy. Probably you will you can look this up here in Google. And Google for the following. It's the Asia range breakout. Same simple strategy. And in fact, it looks at the open range, which is in fact the Asia range, between 1 a.m. till 7 a.m. GMT. And based on that, you can then also formulate a setup based on those parameters. You define the open range. The thing is how to identify the advantage. For example, if you look here at the S&P, you can see it's a 50-minute time frame and exponential moving average 10. If you do this for the DAX, I'm usually working with a 5-minute time frame and working with an exponential moving average of 50 here. So this is the only question you wonder how to optimize here the strategy, but be aware of over optimizing the strategy. This is the thing. So for example, one second, please. So what you have to avoid, or what you definitely want to avoid, is that you say, okay, if it works on a 10-minute, I'm sorry, on an exponential moving or average 10, okay, this is it. The thing is, if it doesn't work on an exponential moving average, let's say 7, and on a 13, it doesn't work on a 13 as well, exponential moving average 13, you should be really careful of trading the strategy with an exponential moving average 10 here, because if it doesn't work well in an interval around the exponential moving average, the trade filter, you will identify your advantage based on. The thing is that it somehow seems to be not that robust, and that is something you should definitely be really careful of. But all in all, it's definitely applicable to all markets, also for FX markets, while the Asia range here, for example, I know about for quite a while, and which is working good, I think, is between 1 a.m. till 7 a.m. GMT. Yes, so let's switch back to the equity markets. What does the S&P show us? Back to 50-minute time frame. This is really interesting. So far, has no willingness to build further pressure on the downside. It's definitely worth noting, because it shows that chances probably decrease. The longer it takes right now to take on further momentum on the downside, chances decrease that we get to see a huge drop on the downside, which is definitely something I have to consider when looking at my current trade here, because definitely what you don't want to see is a market moving something like 200 points in your direction. Now you have to give back something like 100, 120 points. I usually have to work really hard for those 120 points. That's something I definitely know based on my trading journal. And so I definitely have to be careful that I'm not giving back too much of my gains if my target is not reached today. But nevertheless, so far, still confident. I'm still confident. Yeah, and so I hope that that you enjoyed the event here. So we are in fact seeing 3 p.m. GMT on our watch right now. And you can see how to, or I hope that you've learned something, how to adapt or how to optimize the already positive expected value of a strategy here, and then how to really probably professionalize your trading on this based on this knowledge then. And yeah, so in fact, that's it from my end. I have nothing more to add, and I'd really like to thank you that you took your time to listen to what I had to say here. If you have anything to add, if you have any questions, please shoot me an email or contact me via Twitter. And yeah, so that's it definitely from my end. For today, we'll talk again to each other in 1 week from today. It's then the 16th of November. Oh, in fact, no, I'm sorry. Next week, there won't be such an event because there's the biggest trade fair here in Germany on Friday, and I have to travel to Frankfurt next Thursday. So we'll have the next event then in 2 weeks. Nevertheless, if you want to listen to what I have to say or to what I think about the markets here, then please listen to the morning meeting taking place every morning at 10:30 a.m. GMT. And yeah, so that's it from my end for today. Happy trading. What's your stops? Talk to you again tomorrow then, respectively in 2 weeks from now. I look forward to it. See you and bye-bye.